study at IPMI International School. Today, I would like to share the video regarding corporate finance with facilitator Prof.R.R.Roy H.M, MBA, Ph.D, CSR. Here you can see the mind mapping summary during 8 weeks of my class, which I divided into 9 sections. The 9 section is content of 1. Introduction of financial management, 2. Time value money, 3. Capital budgeting, 4. Analysis of securities, 5. Capital structure, 6. Corporate restructuring, 7. Fraud risk management, 8. International finance, and 9. Dividend policy. Come to number 1, financial management. In financial management, we learn about goal of financial management, which consists of basic objective, operational objective, social objective, research objective. And what is managed in corporate finance? In managed corporate finance is consists about this capital structure, working capital management, asset structure, revenue management. And corporation and financial market, we divide it into 2, principal agent problem. What is the principal agent problem? Principal agent problem is a conflict in priorities between the owner of an asset and the person to whom control of the asset has been delegated. So, the problem can occur in many situations. For example, from the relation between client and a lawyer to the relationship between stockholder and CEO. Come to the good corporate governance principle. It is we divide into 5 is transparency, accountability, responsibility, independency, and fairness. And there is also 4 cornerstones of corporate finance. It is 1, it is core of value principle, 2 is conservation of value principle, 3 is expectation treadmill principle, 4 is the best owner principle. Come to the second section is time value of money. What is the time value of money? The time value of money is normally people call is TVM, is the concept that a sum of money is worth more now than the same sum will be at in the future. For example, you have a $1 today, you will get more in the future for the more than $1. And section 3 is capital budgeting. On the capital budgeting, we learn about the methodology about the payback period, net present value, profitability index, internal rate of return. And section 4, it is analysis of securities. What is the analysis of security? Why it is so important? Because the security market analysis is referred to the analysis of markets and securities trade there in terms of risk, return, quantity, rise, or traded price trends and other indicator of the market. So on the analysis of securities, we will see the 2 main course is fundamental analysis and technical analysis. And on the fundamental analysis, it is consists about the domestic global economic. It is quite famous if you read the book from the Warren Buffett way, which is very, we can see the very learned is they saying about the business tenants, management tenants, financial tenants, and market tenants. And also on the fundamental analysis, we also learn about the company analysis. It is come to the financial statement analysis. It is will be have probability, liquidity, activity, leverage, and market ratio. On technical analysis, we also learn about the momentum versus reversal, trend is uptrend or downtrend, support resistance, gap in command and breakaway, triangle, which is include in symmetry and asymmetrics, double bottom and double top, also moving average. Come to the capital structure, is section 5. What's the capital structure? Refer to the specific mix of the debt and equity used to finance a company assets and operation. Capital structure is also the result of such factors as a company size and maturity, which influence the finance option a company may here available. So on the optimal capital structure, we can see about the tax benefit is ROA, expenses, retained earnings, cost of financial distress, is come to the volatility, potential loss of profitability. Section 6, Corporate Restructuring. On the corporate restructuring, why do we need to learn about the corporate restructuring? Because in corporate restructuring is an action taken by the corporate entity to modify its capital structure or its operation significantly. Generally, corporate restructuring happens when a corporate entity is experiencing significant problems and is financially jeopardized. So here you can see come to the three main core. It is financial distress, surviving and transformation business, and restructuring corporate structure. So on the financial stress, you can see also this turnaround opportunity, permanent problem, which is come to the liquidation and bankruptcy. And on the turnaround opportunity, we can see this operation restructure, asset restructure, and financial restructure. Go to the surviving and transformation business. It can be, we learn about the stop the bleeding, how to stop the bleeding. Bleeding here is, we're not saying blood, but bleeding meaning is the loss of our money. So, and then financial restructure, temporary pivoting, strategy realigning, redefining core business, and new ways of doing business. On restructuring corporate structure, we can see this about this capital structure, working capital management, asset structure, and also revenue management, cost management, cash flow management, growth management, and risk management. Going to the section 7 is fraud risk management. Why do we need to learn about the fraud risk management? As we understand, and we can see in the news also, due to this fraud, the company worldwide it has lost 5% of their gross revenue due to this fraudulent activity. That's why on the fraud risk management, we divide into three sections: occupational fraud and abuse, fraud triangle, whistleblowing. And then for the occupational fraud and abuse, you can see here the corruption, asset misappropriation, fraudulent statements. And on the fraud triangle, we can see here the perceived opportunity, rationalization, and perceived pressure. Going to the section 8, international finance. What is the internal finance? Internal finance is the branch of financial economy broadly concerned with monetary and macroeconomic interrelation between two or more countries. So on the international finance, we divide into two. It is foreign exchange rate and arbitrage. Foreign exchange rate, you can see the forward contract, future contract, and the option. And on the arbitrage is locational, triangular, and interest rate. Section 9, dividend policy. What is dividend policy? A dividend policy is the policy of company used to structure its dividend payment to shareholder. Dividends are often part of the company's strategy. However, they are under no obligation to report shareholder using dividend. Then why company need to pay the dividends? Because paying dividends allows company to share their profit with shareholder, which help to thank shareholder for their ongoing support via higher return and to incentive them to continue holding the stocks. Thank you for watching this video. Hopefully, it can be useful and increase knowledge in corporate finance. See you in the next video. Cheers!